Awesome. Thanks, Andrew. Thanks for meeting with me today. And I think this is the second time we've done this, but hopefully this one we can get through and save it properly. But thanks for meeting with me today.
Sure. Good.
Now just a quick introduction to yourself, Andrew. You've worked in finance for a long time.
Yep. That's
How
fair
long
to
have you
say.
worked in finance for?
Too long but let me say it was a bit before 1980 when I started with the Commonwealth Bank. I left
Yep.
at 12, sixth form as it was then. Studied accounting, joined the Commonwealth Bank, and I've been at various institutions since Commonwealth Bank, ING Bank, Suncorp Bank, Morgan Commercial, Global Capital. There's probably a couple in the middle that I've forgotten as well. But so yeah, I had a good
Yeah.
rounded experience, level of
I feel
experience.
like everyone's done a stint at CBA at some point in their careers.
Look, when I joined, all the major banks were fantastic. They had like their training. So, for example, when you became a loans manager, you did a 2 week residential course in their school at St Ives.
Yeah,
So you
right.
came out really trained. Whereas now it's like jump on the computer, do these 3 units. That's it, mate. Look, you
That's
do
it.
your executive. Yeah,
I think my experience at the bank's a little bit different to yours because yeah, we got sort of those quick units and you can take it 100 times as long as you pass it by the end. You
yeah,
know what I
yeah.
mean?
That's right. So they trained you really well. So that's why a lot of people. So it was a good job to get into.
Yeah, right. It was lending was a little bit different back then too. From what I hear, and I'll be honest, I've only been, in lending since sort of 2015, 16 from memory, 17 maybe. But the uh, back then there was a lot more conversation around um between like the bank manager or the lending manager and the person after the loan. So you could sort of almost pitch your idea. Correct me if I'm wrong, because this is
No,
sort
no,
of what
you're
I
absolutely
understood.
right. And it goes back, you know how everyone talks about the 5 C's of credit, right? But there was one of them's character. And in that was one thing I really learned. Like you'd be sitting, if someone would be sitting in front of you, sitting in front of the bank manager who's going to make the decision. And a lot of times, there was a lot of loan application forms that were, on the front you had the guy's name, address, and phone number. Then you had lines through everything else, and on the back, the manager would write a couple of notes and go, been banking here for 10 years,
Mm.
personally known to me, undoubted, proved. And 9 times out of 10, mate, those loans went through without a problem. Of
Yeah,
course, you
yep,
can't. I mean, that's old days, right? You got to now look at
everything.
you've got to look at financial data and that sort of thing. But it really was that big thing to trust. But you
Yep.
can't. You could do that because the bank manager had been working for 30 years.
And they'd
He
make the
wasn't.
call sort of
He'd
thing.
make the
They'd
call. All
yeah.
he'd have the knowledge, he'd have the experience. He had a lot of authority. It's not like now where a bank manager's like,
It goes to the banker, then it goes to the credit, then it goes to the credits
yeah,
manager.
yeah, you've been there for 2 years and you're 3 years and you're bank manager. And those days it was like 25, 30 year job to
Yeah,
get into something like that,
that's true as
And then
well.
retire through there.
Yep, that's true as well. Yeah, like you see a lot of those old movies as well where they sort of go, usually American, but they go into the bank and they say, like, here's my pitch, here's my sort of collateral, and
Yeah.
can you approve it? And they sort of have to sit there and go, okay, approved, big stamp type of thing. And that was sort of it.
Well,
Now it becomes a bit more complex.
your business plan, you now, they ask for a business plan, it's like 42 pages of guff. Then it was like, explain it, work through it, tell them how you're going to get it done. You sort of do the same thing, except now you've got everything in writing, and maybe they're not as well thought out, or maybe
Mm.
maybe they're more standard sort of answers that you give to things. You probably get on Google or get AI or someone to do it and they answer the whole
Yeah.
thing. But I mean, look, you can't relive the old days because the world's a much better place, a much different, a different place. But some of those things are still important, I think.
Yeah, that's right. That's right. It's funny though that we're sort of drawing that distinction because with private funding, which I know you specialize in, and you've even helped me out quite a bit with sort of different private funding scenarios. And before we sort of talk about the difference between the two, I think just because of that segue, I think from what I understand with private funding and from what, I've dealt with in different private funders, it's almost like a sort of a step back in time where you are sort of pitching that sort of total idea to the private funder and say, hey, we've got this project we're working on, or we got this scenario. Here's our collateral, and are you able to, fund that? And it's sort of that sort of old school type of banking. Whereas if I went to CBA these days, yeah, you sort of have to jump through the hoops, make, huge list that you have to tick off every sort of item on that list for them to even, invite you in the door type of thing to talk about finance. Is that sort of how you see a difference between one of the differences between the two?
Yeah, well, I think to a large extent, you're responsible for your decision as being the borrower, and that's the way it is. So when you go into a bank, it feels like you're asking their permission to be able to use your house to borrow your money to do something with,
Yeah.
um, and I understand why. But with a private funder, it's like more okay. So what do you want? What are you going to? How are you going to repay it? Like the exit becomes very important, and and to a large extent, you're able to go in and just get your equity, or draw down on your equity, use it for whatever you're going to do with it, and then it's up to you to sort of get out. But exit strategy, because you haven't got servicing, then exit
Mhm.
strategy is very important in that regard.
Well, that's because a lot of private funding is short term, right? And so
Well,
is
it
that
is.
correct?
Well, it is, but ec- economically, it couldn't be long term because the
Yeah.
rates are reflecting the risk, right? So you don't want to you don't want to be stuck in that. You don't want to be stuck there rolling it over for a long term, because you're paying probably two times what you'd be paying to a bank, or a mainstream funder. So the whole idea is usually the exit is either typically sale of an asset or refinance into a mainstream
Yeah.
funder. You know,
So tell me why people would use private funding. I know the list is almost endless, but what are sort of the main things you see
okay.
of people using private funding
So
and how they use it?
so the first thing is private funding complements your your institutional bank,
Yeah.
sort of funding as well. So you've got to look at it as just a part of that. So you might have, for example, at the moment, we're seeing a lot of people where they've got into, they went through COVID, business people, and typically, and this is the thing, private funding is really for commercial purposes. So it's not for mum and dads and where there's legislation, NCCP, that sort of thing. There are
Mm.
private funders that will lend for there, but I'm talking more the commercial here. So I've got one at the moment. People went through COVID. They kept their business rolling with credit cards and short term business finance, like where you've got to repay them fairly quickly, and then their
Yeah.
tax sort of as well. They've used their tax a little bit as a thing, and then they're starting to sort of get out of that, and the interest rates go through the roof, and people stop buying, and then so things have got to a stage where they're stretched on a cash flow basis. So they might have a home loan at 6%. They might have a few business loans where it's cash flow loans at 12 to 15%, maybe a bit more. But
Mm.
the actual repayments are very substantial. The bank's got them screwed back to 7 years to repay their commercial loan, because their financials don't look so good. So you've got to pull people out, refinance everything, get rid of the tax debt, get rid of all the short term uh, debts, put it into consolidate it. You're probably paying 10.5% or something like that, but you're looking at a 6 to 12 month term.
Mm.
As long as the fundamentals are good, you can get you can trade, have your financial statements, have a clean loan statement, and
Start
refinance.
fresh. Give them
Yeah,
a
or
breather.
sell it. Right. I got
Mm.
another guy that's looking at he had a debt that he had a business several years ago with other people. He guaranteed a loan, and he owns a house with him and his mum. And the trustee for the company's gone to the wall. The trustee's coming through taking half his property, so he needs to pay half that loan out to get that house back into his name.
Yeah.
Going to renovate. He's in the construction industry. He'll renovate and then sell, and him and his mum will take profit, and then they'll move from there. But it just gives them the ability to take it, get the ownership, sell in an
Start.
orderly manner,
Yeah.
and take control back.
I like that you said that take control back, and especially when whether you're talking about a trading business who's racking up debt, or whether you're talking about that scenario where, they had a business and it's now sort of gone bust, and they've left with a scenario that they're struggling to manage, and they're trying to keep their head above water.
Exactly.
private funding can offer that solution to sort of just start again, consolidate everything, bring it back down, give them a breather, give them time to sort of sit there and work on their next plan and the next goal to basically repay that or exit from that loan.
Yeah, well, I think it's important as a broker that if you're putting people into a private funding, that you work on a total solution. You need
Mhm.
to talk to them initially because it's not going to be sustainable for us a long term. So they need to know that. They need to know what they have to do, what the plan is. Um, and for us, it's not really that difficult because you can see you can step back outside the situation. You're not
Mm.
involved. You're not living. You haven't got that stress. So you can step back, give them a solution, tell them what they've got to do to work it through, and then execute it, get it done, and then so they go from being under a whole heap of stress to getting a refinance and being cheaper cash flow, but still a little bit of stress because going we can't keep this loan going forever because
Yeah.
and then but then you're putting them into the third phase, which
Yeah.
is basically then setting them up for the longer term
A-
or moving them out of the
And that
situation.
goes to what you were originally saying too, where you're saying private funding complements your
Mm,
traditional institutional type funding as well, because that private funding really is just a solution to a problem or a solution to something you're trying to achieve. And then that traditional funding sort of comes in and sort of takes control of that once it's to a position where you're going to have a high chance of approval with that traditional funder or that institutional funder.
exactly. Yeah.
Yeah.
No, that's good. The other thing that private funding is very, very popular with is construction development.
Yep.
So where a bank has, again, the banks charge a low rate. The
Yep.
expectation is that so they want a high credit position, which is understandable. So the private funders, they'll charge you a high rate of interest and take a lower credit position. They'll look at the development project as a business if you want. So it's a one,
Yep.
So they will look at it and say, well, it's in a good position. We don't need pre-sales to start.
Yep.
Um, so you can start, you can, so because you can start, you can get through the project relatively quickly. You can sell from you can start marketing almost from when you start construction, but you can start really selling from 6 months on, so people can see what they're getting, so you
Yep.
can maximise your revenue. So quite often, notwithstanding that you're paying probably double what you pay bank funded for finance, your bottom line is probably it would be typically higher because your
Yep.
revenue is higher. But the other thing is too, you can get maybe 3 projects done because you can start without pre-sales. You can get 3 projects done in the time where you can get maybe 2 done.
Yeah, right.
So your return on your equities increase substantially as
That's
well.
right.
So
And
again, it
the
comes in useful.
and the I've spoken to a few major banks about potential development funding projects from my customers, and as the conversation sort of starts and they sort of, they all sit there and we have coffee and they go through, I'm saying, look, here's the project and this is what we're looking at doing. And very early on, I find that my client's not going to take to this. There's a lot of documentation. There's a lot of hoops they have to jump through. And like you said, they take a higher risk. Their risk appetite is much lower, I should say, sorry, than the private lenders. And from my client's perspective, they just need money that they can just put straight on their book. They don't have to provide too much. They just have to provide sort of collateral and a good business plan and a project idea, good feasibility, and they can get approval that way through a private funder, or they can jump through hoops, show a long background of development, be able to sort of a lot of lenders as well want them to be banking with the bank as well, like that sort of old school type of lending. Whereas private funders can sort of bridge that gap and say, yeah, it's a bit of a higher interest rate, but let's get you funding now and let's get this project off the ground.
Yeah, and with the development construction, your finance costs are only a part of your cost. When you're buying a house or you're buying a factory, your finance cost becomes the expense.
Yeah.
So it's not as certainly when you're constructing, you've got your construction expenses and your as well as your holding expenses. So your finance costs are only part of it as well. So it's not as big a part of your outgoings.
Yeah.
But as I said, at the end, typically, if you're trying to pre-sell something, people, especially nowadays, they want to see a discount. If they're
Yeah.
going to have to put up 10%, they want to see a discount. They're also hesitant to, more so now, I think, than ever before. There's always been a bit of hesitancy, but people don't want to buy off the plan. They don't know they don't know when the construction is going to start. They don't know if it will start. They don't know if it'll complete. They don't know if the builder's going to go to the wall.
Yeah.
And
Yeah.
the
Especially with
deposit's
the
going to,
last 2 years of
yeah, and the
history with
deposit's going to be held in
construction.
trust, but people don't, they still don't think that. So if you've got a site where your construction's moving, people can see it's moving ahead, it's being built, they get a feel for what it's going to look like, they can start to fall in love with their property, and they're going to pay you you're going to maximize revenue.
That's right. And I think like, those sort of institutional funders and this is sort of what you're saying is they will rely on those pre-sales. Some of them even want 100%. We want 100%. We want everything sold before we even give
Yeah,
you,
that's true. Not
any
even
type of
debt cover, they
funding.
want more. Yeah,
But you speak to a developer, and a developer usually want at least the frame up, before they can start selling it because the customer wants to see it.
yeah,
They're going to make more money from selling something with the frame up than if they're selling, a piece of air that's not even registered yet, a piece of land that's not
yeah,
even registered yet, depending on the project. So, that's a huge difference between sort of that private funding in the development space and the institutional funding in that space is that they're happy to take that risk with no pre-sales or minimal pre-sales. And I want to also jump back and talk about um, interest rates and fees
yep,
for private funding versus like institutional or,
yeah,
or, or bank funding. One of the things about private funding that people are a little bit scared about is when they're so used to hearing rates, and it flashes across buses, and especially they're so used to residential mortgage rates that are completely separate to private funding in multiple aspects. And they'll see it on the TV, they'll see it advertised. They know rates are going up and they know that the market's like that. But then when you sort of hit them with a 10% private lending interest rate or higher,
yeah.
depending on the project, there's sort of like this visceral reaction, and why are they charging that much? Why is that rate? Maybe you could explain a little bit how that works and why that's suitable for some people, even with a higher rate.
Okay, so looking at, okay, so you got your term loan sort of thing, right?
Yep.
Well, and then we've got a construction development with a term loan, really. So where you've got a finished product, and there's got to be a reason why you're not going to the institutional banks or your non-bank
Mm.
funders.
Mm.
Uh, so usually that's your first thing you look at. So that could be because you might be buying a property that's dilapidated. You might and you're gonna uh,
Fix it
refurb and
up.
refurb and put tenants in. You might be buying a shop that's not tenanted,
Mm.
or a few shops where it's not fully tenanted, so you can't show your servicing. Or you might be your credit or your position. You might have a tax debt, which means as soon as that comes up, you're not going to qualify anyway. So there's always reasons behind it. So I think the first thing is to point out, you don't get me wrong, you're always up front with what the fees, what it's going to cost, right? I
Hmm.
always make sure I put that in writing. Very first email to whether
Yep.
I'm just a referrer, a broker, or a client. So we let them know straight away. Get that rate shock out there. Let
Yeah.
people look. The reason though then is, well, because of these reasons, we can't go to the mainstream funders at the moment. We need to get you out of this hole. It might be like, for example, one of my properties, one of my clients, we've gone to 10.75, just instead of a couple of bank rates and that sort of stuff. But they're paying $20,000 a month in repayments on everything they've got. By putting the $1 million on 10 grand, we're winding that back to maybe
Mm.
12 grand a month. So
Yep.
straight away, they can see a benefit of 8,000. Now the thing is too, you've got the next. This is what I was saying before. You've got the next phase where you say to them, right, so this is a short term. This will get you out of here, and then when you've got you keep trading. You've got your financials. You've got all this stuff out of the way. You've got your tax bill paid.
Hmm.
In 6 months' time, you've got 6 months of clear, depending on what you funder want, 6 or 12 months of repayment history. Plus,
Yep.
you've got your accountants done your figures, and you've got your tax returns in. So then you've
Yep.
got your 2 years, 3 years, or whatever they want. Good trading. Your debt's in a manageable position,
there's more cash towards other
More
things in the
cash,
business.
yeah.
So
So
you assume the business
you
is also doing better. Yeah.
exactly. You've built it up. You've spent money. You haven't got the stress where you weren't about making loan payments. You actually built putting in. And then the next phase is we will go back to a bank or one of your non-bank. There's plenty of
Yeah.
non-bank guys out there that will take where the credit's maybe not. They might have a bit of a dodgy credit record, but I think that's the important thing to when you definitely show the rates. I'm saying you hide the rates, but you've got to show it as part of a solution,
Yeah. Yep.
and ultimately they will make the decision. Look, I've had one recently where we showed there was good benefit, but we spelt it all out. We left it with the clients, and they've come back and said we don't want to go ahead. And for me, I'm happy with that, right? Because it means they've thought it through, they've had a look at it, and it's not for them at this
Yeah.
stage.
Or they fit. Yeah.
Rather, you'd rather someone rush in, right? So that's the first way you look at it. If you're looking at a construction development loan, you go, okay, well, let's say you're going to be paying all up cost 15% instead of 6.5, 7 with the bank.
Yeah.
Uh, those are just approximates. They might not be exactly there. So you say, okay, so let's build in. Look at if I've done this before. I've got someone's feasibility that they've put together. The only thing that's changed, I look at their interest and even if it's not exactly how I would have worked it out, take their figure. Okay,
Hmm.
so double that figure. Now, what did you work your repayments, your revenue on? So we've got all their expenses set, so they understand it. You're not playing around with the figures.
Yeah.
The revenue go, well, was that based on pre-sales? Or was that based on sale at the end and maximizing return? Well, okay, if you've got to pre-sell it, how much will you have to give away? So you
Yeah.
reduce that down. So by using their figures and only changing the interest, so they understand that, and the revenue either up or down, depending on how they've worked out, they can then see the bottom line roughly change one way or
Mm.
another,
Yeah.
or maybe stay similar. Now, we're not being tricky, but if you change a lot of figures, then they start to think what's going on behind the scenes, right? So it's really important to use their figures so that they understand where the figures are coming from.
Yeah.
But again, they can see that. They can also see, so most people can see the benefit of the bottom line. If
Hmm.
people have developed or they're doing some developments, they can also understand a return on equity. So start a project quicker, sooner, get it finished and be able to do 3 projects in the time it'll take you to do 2.
Yeah.
But not everybody sees that value or understands that value.
Yeah.
But that's how it is. It's just like tell them straight, make sure they understand it, make sure it's in writing so they can go away and look at it and think about it and not think, did I get that right?
Yeah. Yeah.
And then work through that way. But the decision's always theirs, and people will work things through themselves, right?
Yeah.
You explain to them, but you know, you you don't need to pressure people. They have a look at it, and in the end, they'll go because in the end they'll come around with it and they go, well, the fact is, we've spoken to the banks and we can't get it there. We can't get it here. We can. That means we can make our profit. All right, we can make 100 grand less than we were hoping because we've got extra interest. But when you look at it the other way, if we do get as he says, if we do get a better price at the end than pre-selling it, we might make, we're probably going to make more anyway at the end. Once they
Yeah.
do first
Yeah.
time, they're usually
And it's,
pretty happy.
I guess it's just important that when they do their feasibility that um they are realistic though. And I know you said you sort of change things around, but having that conversation up front with them in relation to the pricing, which you said, be upfront with the pricing, be upfront with the fees, help them, you know, process a realistic feasibility because I think when people come through, they have a certain expectation. And then once that's happened, then there's a little bit more clarity and they've got a bit more confidence. The lender's got a bit more confidence, and they've got a better chance of approval. You did mention something as well where you said the by consult and going back to sort of that trading business scenario again, as opposed to developing, when there's a lot of outgoings for different debt repayments, and especially when a business gets into a, a position where they're saying, "Hey, I want sort of the quick turnaround funding," and you get sort of those. I won't say any names, but you sort of get those
Sure.
sort of short 12-month, 24% interest or 2% interest per month type of
Yeah,
thing. And they're getting into that spot. And then when it sort of comes to getting them out of that and getting them to reset and restart with clearing all those debts and giving their business some extra cash flow, that 10% actually doesn't look that bad. That 10% actually looks like a pretty good aggregate interest rate compared with all their asset finance and their commercial loans and their short-term business loans
Oh,
and their overdrafts and all that type of thing. I think even from a major lender, a lot of overdrafts are sort of sitting at sort of 12%, 13% at the moment anyway. So, by consolidating a lot of that, especially unsecured lending and putting it back into a secured private loan for a short term with the
yep.
solution that they're going to reset and then we can transition that out to maybe more institutional lower interest rate, is a great option for businesses, right?
Well, it is, and you also there's that. The other thing to there is that. The other thing too, which you don't always take into account, is the amount of, which I've seen a lot of, is the amount of stress that's on these guys. They're not typically you talk to them, right? They're not sleeping because they're worried about things,
Yeah,
right? So aside from that, you put them in a position where all of a sudden there's a weight lift off their shoulders. They can they can sleep. They they know there's a plan, and everybody when they've got a plan, an achievable plan, feels like they're moving forward. So there's those other benefits as well. And I would reckon that you'll end up when it works out, as long as it works out, at the end you'll end up with a client for life. It's a break, because they'll
yeah,
remember
yeah,
that you've got them out of this problem. And 9 times out of 10, they're not remembering the financial cost. They'll remember the emotional cost, the stress of going through fight,
absolutely.
flight, yelling at the kids, kicking the dog, all that sort of stuff that they've been bottling up, and
That's
then
so true. It's
once they're
something that
embarrassed,
you can't really gather data on that, right? You sort of just go, yeah, we
you
got them
can't
on
put
a
a
better
dollar value
interest
on
rate.
it, but it is a huge thing. You look at people, you look at your clients when you get them out of a hole.
It's that weight lifted off their shoulders. You're absolutely right. I think one of the first things I learned at the bank, and you've probably heard this 1,000 times too, is that money is emotive. And so people are emotional about money. And it is, not to get too philosophical here, but we know that's a lot of sort of relationship issues, between a husband and wife or, parents or something like this, quite often will come down to finances. And especially if you're a small business running a business is in itself just fundamentally stressful, and it does consume someone's life and they're trying to constantly do better. And when they get into a position where there's COVID or they've got a whole bunch of debt that they've racked up because they needed cash flow or they wanted to do something on a project, um, and then you've sort of come in and offered a solution to them, and that solution's given them that breather, given that space. Yeah, you're the hero, right? Well, and it's not all about numbers. It's not all about, yeah, will the numbers work out? Of course, we do that in the background as a broker. We want to
Yep.
make sure the numbers work out and they've got a solution long term. But you're 100% right. There's a lot of emotion involved that you can actually help a lot of people out through, private funding. I love how you've actually addressed that because you're right. That's not something that's not regularly talked about when it comes to funding solutions, is that
Well,
there's an
we
emotional
talk
aspect.
figures, right? Like that's our business. That's
Yeah.
it.
Yeah.
Yeah,
Just looking at numbers all day. So these are real people, and then people have those sticky situations, and like the one you're mentioning before, which where someone's going to take the
yeah,
house off them, pull the house away from them and kick them out on the street, figuratively, but. We say figuratively, but that's they're going to have to find another place to
that's
live
right.
because they put their house up for finance and they need a solution to that. And so it's important to sort of have options that offer that solution. And you're not going to find that often at an institutional bank,
No,
because they're going to have that higher risk threshold, especially if there's credit issues, late payments, those types of things.
yeah,
Yeah. Yeah. Now, when it comes to getting projects, I want to have a chat a little bit more about development. Yeah, I wanted to talk a little bit more about development and how that works. I think what I have is that there's I always differentiate between there's a property investor and then there's a property developer.
yep,
And they're two different things. One's usually to buy, rent out and hold and build wealth and that type of thing, whether it's in a company or whether it's in their
yeah, sure.
personal name. And then you've got the developer, and the developers usually buy to sell. Or they buy to pay back that loan in the sort of short term. They just want to build and construct and develop property. Um, and a lot of people like the idea, especially that as a lot of people come to me and they love the idea of being a developer as opposed to a property, investor. They see or they hear stories or they've done a quick feasibility and they think, gee, the profit's huge on this. Like, why? It's a no-brainer. I want to be a property developer and I want to make millions of dollars. Um, what advice would you give being in this sort of space in private funding and in, helping a lot of people with their development projects in the past? What advice would you give to someone who's green, never done a development in the past and now wants to get into property development?
I think the first thing is that it's like everything, it's never as good as you initially think it is. That's not to say there's not money to be made. Um, let me tell you, I have not developed anything. I've only funded it, right? So I'm not speaking from experience on that side, but from a funding perspective, first time I would say pick something manageable. So don't try to build 15 apartments or something like that. So look at something that's going to be relatively easy to build. So if it's a duplex, um, if it's townhouses, something that a builder can easily build, so you'll minimise your the risk of the construction not panning out. Make sure you've got plenty of equity in the property, and by that I mean don't if you've got more than 50%, if you give more than 50% against your initial site, then that may be too high. You need to sort of have a look at that early on as well.
Mhm.
Um, and then if you're inexperienced, just get some good consultants around you. So you you'll speak to get a project manager, get a builder, someone who's going to be able to outside of your contract builder, someone who's going to be able to lend some advice and maybe manage it through. And it might cost you a little bit more,
Yeah.
uh, but you'll get that you'll get the knowledge. You'll see what's going through. You'll build some experience,
Yeah.
um, and the chances are you'll still make some. Well, not the chances are. Ideally, you're still going to make some good profit out of it, and then
Yeah.
you built your equity up to go into the next project. If that's what you want to do, or to walk away with your profit. But I'd always say pick something that's achievable and that's easy. You're
Start
not
small.
fits, yeah, whatever that means for you or the
Yeah.
person, depending on your experience level.
I think you've addressed a really good point where you say basically surround yourself by, people who can help you through it and not just this is not friends and family, but with professionals
Yeah,
who can advise you and give you help, especially if it's your first time. Um, and I think I think when people are first developing, they've got this idea that they want to cut as many corners. They'll do something as much themselves as possible to sort of
yeah,
save
yeah,
money.
yeah,
And they'll try to project manage it. They'll try to do a little sort of owner builder type thing. They'll try and cut those costs as much as possible. And I like what you said, where you said, it might cost a little bit more, but it's good to have somebody or people to come and keep an eye on it and help you through this process, even if you have to sort of pay them to do it. And at the end of the day, you've got that feasibility, you've got that, idea of the project costs, and you tack that cost in there and you see if it's still profitable and if it's your first time, yeah, work through it. Make those costs, make that first experience as easy as possible so that you can rinse and repeat sort of again and again, right?
yeah. Well, I've got to sell this to a bank or a funder, maybe not a bank, a private funder. They still private funders still want to know that the deal's going to be done. They don't want to have to step in, get rid of the to complete the project. So if you're inexperienced, I've got to then show them how we're going to mitigate that. And typically, you mitigate that by your your consulting team. Now, you don't have to have a huge team for a small
Yeah.
project, but you do need to have someone bigger. So you might have a superintendent or someone looking after, but you do have to have someone more than the builder. So a lot of people go, oh, the builder will do that. Well, no, the builder's there to look after himself
Yeah.
or herself to build the thing. You need someone to manage it from your perspective, or so you've got to oversee. You've got to make sure the builder's turning up. You've got to make sure your costs are still, you haven't got too many overruns. It and the smaller the project, the easier that becomes. You've got fixed price building contracts, but they're only good as long as the builder stays in business,
Yeah. That's
right?
true.
Well, that's it. So that's why for a larger deal, you're going to have a quantity surveyor involved. The funder will get one,
Hmm.
For your smaller deals, they may not. So that then falls back onto you. But it's just from my perspective as a broker, if I'm going to a funder and I can say, well, this guy's never done this before, he's an accountant or a finance broker by trade, or he works in whatever. So he doesn't have a experience in that area, but he's got an architect or he's got a project manager. If he's doing a subdivision, he's got a surveyor that's going to project manage it, and that then gives some comfort to the funder as
For the
well.
funder, is that a common misconception that you get in relation to private funding? That the private funder's just going to say, "Oh, ask no questions,"
I
sounds
think
good.
people
We'll,
think that, but I also think people are realistic
yeah,
when they think it through themselves. I think because yeah, okay, well, the guy's still got to get their money back. They're borrowing money from people like I always say this is typical. They're borrowing money from people like your mum and dad, right?
yeah,
So they're investing. So it's solicitors fund. So would you, if you've got your mum and dad's money, are you going to lend it to some bloke and say, mate, trust me, I'm going to build this. We're going to
yeah,
reform. We're going to make. No,
yeah,
you wouldn't. You'd expect, and they've also got, even though they're private funding, it's not like they're cowboys. They're restricted by their investment trusts or their investment agreements with their investors.
yeah,
So they've still got due diligence on it. Um,
yeah.
so they may, and you might find that they'll fund one for you. The next project maybe they won't fund it. It doesn't mean that
Mm,
they don't like you. It just means that it might not fit with them or their location,
yeah. Or they've maybe done too many of
exposure.
those types of projects,
Or
or
they might
yeah,
be cashed up,
yeah,
cashed out. They might be cashed up at that stage. So you've still got to look at it where you're going to different funders. But yeah, that experience is, if you've got experience, the more you build, the more experience you get, the more problems that you're able to solve yourself. When your very first one, you're not used to seeing any of those things come in, so you get someone who is,
yeah,
and it's not, project managers don't, as long as you get, you get a good one. So they're not really a major expense.
yeah.
They're just managing it for you, making sure that when the progress claim comes in, the work's been done and it's done at a satisfactory level. That's
Yeah.
all been certified correctly and that sort of stuff.
Now, can I ask, would you, I was gonna get you to maybe think about this a little bit, but is there a circumstance where you can come in with $100,000 and develop a property and be a developer with a
For a
private
hundred
funder?
thousand dollars,
$100,000.
um,
Sort of a
you'd
leading
have to you'd
question.
have to go to a regional area, I would say, because you've got to look at what you get.
Cost of the
The,
property. Yeah.
the problem will be this, right? You've got the cost of land in any of the metros. So move out of a metro area. You need to have you need to really have ideally 20% of the costs, right? If you've got a bit less than that, it's okay. If you're in a regional area and you're doing a small thing, you got 100 grand, you've got to have 20% of the total cost of the land, cost of the construction, including all the soft costs as well.
100, that's 500 basically in total.
So what I would say to you is this, right? If you've got 100 grand, you would do what a lot of my clients do as well, even though like I've got some experienced developers, they do a lot of the buying property, renovating and refurbing. So they buy one that's oldish, and then they make it look very new,
Yep.
and then they sell it.
And
So
resell it. Make a bit
yeah,
of a
so
profit. Yeah.
so so it's shorter term. You've got cosmetic work substantially. So you move in, you get the kitchen, the bathrooms ripped out. You probably have a look. You might need to tart things up, paint it, and then flip
Flip
it.
it.
And yeah, so
Yeah.
you work out if you can do that with 100 grand and buy a property as well.
The only reason I ask that is because it's you know because we do put out a lot of content, we do get a lot of people who come through to us, and they sort of say, what's the minimum I need to develop property? And we offer a very similar answer, but I just wanted to know if someone just had $100,000, they don't have a bunch of equity, they don't have that, can they still get into that development? And I think you've answered it, like a small regional property that you can sort of just purchase and flip, with an sort of an 80% loan against it. Then you could make a little bit of a profit, and you can try to do that a few times until
And
there's
and
more
you
money.
build that. Hundreds pro look, I always say to people, just as an
100's probably
example,
low.
okay, you in a major metro area, you don't be geared more than 50% against the land.
Hmm.
Um, So somewhere between owning it outright and if you own a place outright, you'll be able to get the funds for it.
Yeah.
50% geared, maybe. And 50% against the value as a site, not the value as like people come say, oh, my place is worth $2 million. But then when you put it through the FISO as a site, it's only worth $1 million or something, right?
Yeah. Yeah.
So then you've got to say to people, so if they're so sure that it's worth 2 mil, you say, well, sell it now. It's not worth doing what you're looking to do because
Mm.
you know as well. But if you've got, yeah, if you're geared more than that and with the cost of construction, depending on what you're looking to build, you're probably going to be you're probably going to be about limited. You know, you're going to be limited to what you can build. So you
Yeah.
can't build. You know, so that's sort of how
Yeah.
it's very hard to answer that.
And I know, I know. I just sort of asked the question. It's just something that we constantly people come and they say, "Yeah, I've been saving up and I want to develop, but um, you know, a couple of things you said, start small, and that is different for everyone. Sort of start small, get a few things under your belt, understand, even if it's just property flipping, something like that, especially if you've got a bit of equity. Now that $100,000, there's a lot of question that goes above that. Is it $100,000 with equity in a property? Is it $100,000 and nothing else? You know,
Maybe
um,
find someone else with 100. You
yeah,
know,
that's right. Maybe find someone else that you can
talk
join
to your
together and
accountant,
do.
see if he's got someone in a similar position, and you can set up a partnership. You know, do it properly, but that might work well.
Yeah, yeah, that's right. That's right. The when it comes to like property flipping and stuff like that, where it's not a development, it's literally just buying a property, renovating and reselling it. Is that something that a lot of private funders look at as well?
Not a lot, a few do because the borrowing level's typically lower.
Yeah.
So, but yeah, there are people that'll do it. You've got to the funding method depends on the person's situation.
Yep.
So that becomes sort of it's difficult to answer. But
Yeah.
there's definitely ways to fund it.
Yep.
Typically, your loan amounts are smaller, so it's not going to. So you don't want. So when I say that, you don't want to go to a. You don't want to put it with a development funder or a private funder that specialises in development because you've got by the time you add your legal fees, which they're not a percentage of costs, and your other costs on it just it doesn't become a cost efficient way to do it. So you've got to look at
Yeah.
other options, and there are options to do it. Just everyone's sort of different. That's all. It just depends on where it's where you
Yeah.
want to see it. Most of your banks and non-bank funders and residential lenders aren't interested, as you know, because
In that type of thing. Yeah.
yeah, I mean, there's plenty of people do it without telling them, but that's probably the last time they're able to deal with that funding.
Yeah,
So it's
yeah,
always
that's true. Yeah. Yeah, that's true, actually. Yeah, there's a lot of people that probably just get sort of a long-term loan, and if they can show servicing for 30 years, then they can sort of jump in and do the flip.
we've had a few people come to us and go, "Oh, we bought a house and we've financed it with X, Y, Z. We've knocked it down, and now we went back to the bank to get the money to build, and now they want us to repay." And it's like, well, you probably should have spoken to them before you got to that stage.
Yeah, yeah.
Like now you're in default in the big way.
That's right. That's right. And the property, your loans probably far exceeds the property value.
Oh yeah, don't
Um,
even think
I think
about it.
that's what a lot of people don't actually know that when you do go to see the private funders like to sort of get involved in the whole project, the whole idea of what you
Yep,
want to do.
yep,
And it's important to be very clear with that up front because when it comes to us being brokers, we need to know where we're taking you. That's actually got to be beneficial for you. If the idea is to flip the property, knock down and rebuild, then there are lenders that we're going to take you to. There are some products that we would introduce you to. And there's some lenders that we definitely won't because they're not going to look at that. And you're going to find yourself in a world of trouble if you go down that path with that lender, even if the interest rate's, particularly enticing. There might be better solutions to your
yep.
plan. Um, I was going to ask a question about knocking down. Oh, that's what I was going to ask you. You're talking about $100,000 and you're like, that's not enough. But one of the reasons where I didn't ask this, and I sort of read between the lines when you're answering too, is that cash flow. You put all that cash towards sort of a project, whether it's $100,000 or whatever it is. But if you're putting all this cash towards that project or the purchase or the acquisition, and then you're left with nothing in the bank account, how important is cash flow when we're talking about developing property when it comes to the lending side of things.
Well, I think you look at it, you got a balance, right? You got equity.
Yep.
So if you've got the equity there initially, then you can afford to be borrowing your cost, your construction costs, depending on where your LVR is. Now you can you can you can increase or you can gear up with a second mortgage if you want. So you've got you've got to look at two things. Your cash flows, you settle your savings and your equity. If you're light on, typically people first time anyone, they're light on equity and they've dumped everything into it. So they're sitting there hanging out, going, "Geez, I hope I'm not, I hope I haven't got to use 10% overruns or 5% overruns, something." The fund is going to build in 5% contingency.
Yep.
Because your QS will tell them to do that, but you still got to make sure that you don't that it's the construction runs to time, because you've got a finite time on that where your interest is capitalized.
Yep.
And so, and that's the important thing about having your consultants there. They're making sure you've got to make sure that your things run tight. It's brought in on budget and on time. That's two lines which everybody talks about, but that's a difficulty. And the tighter you are with your funding, with your funds initially, that's not to say that you shouldn't be that you shouldn't manage your funding and your funds well, but it means if you've got nothing in the bank to cover any substantial overruns, then you've got to borrow it, and then you're at the mercy of the funder. Are they going to lend it to you? If not, then you've got to go to second mortgage. So then you're paying 24%, per annum plus as well. So that's where you've got that. That's sort of where that plays out. So the lighter you are, the more you're flying by the seat of your pants, the more difficult it's going to be.
Yeah, yeah, and especially if you don't have sort of a third party builder who's doing sort of those progress payments for you, and you're sort of managing that aspect of it as well.
But that's
That
right.
can,
You've got to build that in.
yeah, exactly.
Yeah.
I actually spoke to a builder on the podcast uh, just at the start of the year, and he was talking about how, if you buy all your costs up front, and your frames and all this type of thing, but the funder's not going to give the funds until a particular milestone. He's like, you'll run out of money before they pour the slab, and you're gonna.
That's right. I've got a developer that does that, but he's a very, very experienced developer. He builds high end things. So he got all this steel work. So when I say this, he's building individual houses at the moment, which are selling for 5.5 mil each, right? But he's got four lots. One is built and is sold, and the next one he's moving into now. But he bought a lot of his stuff overseas, but he bought that for the three. But he was able to gear up. We were able to get funds against the vacant land, probably fund as well, to give him the mill or the mill and a half that he needed to buy that equipment. And then he's also got a fee. He's also building on a fee basis, not a fixed price basis. But he's able to, at each stage, then recoup part of his. So each progress payment, part goes to the builder, and then part comes back to him for what he's built. But I wouldn't recommend that for someone who wasn't experienced, because he's bought some of his stuff. He's brought in from overseas. Well, because he's been trading for a long time, he's got good connections overseas. He got top quality product. If you don't know it, it's not
you're gonna get yourself caught.
But yeah, that's right. The other thing too is building contracts are different when you do a development. So building a house. So when you build a house, you get 5% at slab, 10% at frame. When you're building commercial development, you have a quantity surveyor involved. So your contract is based on the basis that they'll lend against the QS report. And the funder will always reach. The QS report says this is how much has been spent. This is how much you need to complete. The funder will always retain what's needed to complete as well. So it's you can get into a situation where the builder wants 100 grand. The QS says, well, this is what you've got to complete. So there's only 80 grand left.
Yeah, and there's a shortfall there.
There's a shortfall there. So that shouldn't sort of run like that, because you find that we use a builder that's not used to using the building with those contracts. They get a bit nervous about them. So there's a few things you got to look out for, but that's just.
But I guess it's important to have some funds sort of tucked away anyway,
Always.
just in case those occasions do happen, especially the unforeseeable. And you mentioned like a 5% contingency, which is fine, but I found that when people are more conservative with their contingency, maybe a 10% or something like that, it's even better because then they can sort of say if there's any
Right.
issues, they've got some money in the kitty that they can pull out and address those issues without too much of an effect on the project.
You're right. Yeah. So the funder will keep 5% because that's the standard. Sometimes the QS will recommend higher, depending on the
Yeah,
situation. But usually it's 5%. But yeah, that just because they keep 5% doesn't mean they're looking after themselves. You need to the client
exactly.
ultimately needs to look after themselves too. But yeah, if you've got it's like but it's always a juggle. If you had that much equity, you wouldn't have the problems you got. You know,
Yeah, that's
you've got
true.
to make that first step. So it's a juggle. But
Well, look, no, I appreciate you jumping on again, Andrew, and I'm just looking at the time. I don't want to keep you because you probably got a bunch of people to help out now. But I really appreciate you jumping on again and sharing your knowledge, especially about sort of that private lending, developing. I'm hoping that anyone that sort of listens to any of the information that we put out there can learn a little bit, and if they have any questions, they can sort of come through and we can help them.